Housing affordability hit record lows in 2022. In fact, it was 60% more expensive to purchase a home than it was the previous year. 60% for the same priced home. That's bonkers. Today, we're covering the Denver real estate market outlook for 2023. Let's get started. To understand where we're headed, it's important for us to take a step back, look in the rearview mirror, and understand what KPIs, metrics, and events led us to where we are today so we can best forecast where we're headed next. So as with any market, values and prices are always going to follow supply and demand mixed with an element of affordability. So 2022 can truly be remembered as the year of two markets. We had the first half of the year market, and we had the second half of the year market, and they are vastly different. We're going to dive into a little bit of both. So let's start with early 2022. We have low supply, we have low interest rates, which, as we know, is a fantastic recipe for rapid price appreciation and limited supply because many sellers are hesitant to sell their home, become a buyer, and enter the buying frenzy. They're just not interested in that. In fact, during that first half of the year, the Denver area saw the highest ever on record average sale price. So I'm going to pop over here to the Denver Metro Association of Realtors report. And you can see this is the single family home peak, 821,258. If we scroll down and we want to consider looking at both the attached and the detached market, basically all of residential, this was our all-time average high, 721,767. So if we fast forward to December, 6 months after the rate hikes resulting in an almost completely stalled buyer pool, that average dropped down, as you can tell here, to 637,852. Now, if we scroll back up and we want to see just the detached single family market, which is the majority of our market, that dropped to 707, down from a peak of 821. As you can tell, very different markets. Now, contrary to what we think logically, buyer demand was not the only part of the market that was hit by these high interest rate spikes. In fact, listings also took a huge hit. In fact, in 2022 as a whole, we had 9.3% fewer listings hit the market than we did in all of 2021. Now, that happens to be the fewest number of new listings hitting the market in a single calendar year since 2008. That's pretty significant, but it also makes sense. So I want to unpack that for just a second. So when a seller puts their home on the market, generally on the other side of that sale is that seller becoming a buyer. So in Q1 and Q2 of 2022, they didn't really want to enter the market because they were going to have to join this frenzied buying pool. So that kept supply low in the first half of the year. Yet in the second half of the year, interest rates were much, much higher. In fact, almost double. So they were going to have to trade a 3 or a 4% interest rate for a 6 or a 7% interest rate. So suddenly, sellers had this significant spreadsheet problem. Or in other words, just their net to their bottom line was being deeply affected. So suddenly, the desire for that extra bedroom, that bigger yard, or just more square footage suddenly became this mental hurdle that had to be overcome. And many decided, you know what, it's just far too expensive for us to make this jump and make this change and give up our 3 or 4% rate in exchange for a 6 or a 7, which significantly constrained the supply. Now, another key indicator of market direction is months of inventory. So that can be described as the consumption rate. How many months would it take before all the homes on the market were to be bought up by buyers if no new homes were to hit the market? So each month, most markets will actually measure, hey, what are the months supply that we have? So I'm going to read a couple of significant numbers here. In January of 22, we recorded 0.42 months, which is about 12 days of inventory, while December recorded 1.75 months, about 52 days. So the previously agreed upon metric for what is a balanced market according to the National Association of Realtors was 4 to 5 months of inventory. Yet right now we have 1.75 months of inventory, which is 52 days. That feels a lot more like balance to me within 4 or 5 months. Our reference point for the last few years has been such rapid fire, fast days on market, quick escrow periods. Maybe it's time that as a whole, we just rethink what is considered balance, because it certainly feels a lot more balanced right now. So now that we have thought about what got us to this point, here are 5 things you need to know about this year's real estate market. Number 1, mortgage rates will continue to stabilize. So after surpassing the 7% mortgage rate threshold in November of last year, we have continued to see inflation come back down, which is favorable. With inflation coming back down, rates have been slowly coming down. That is exactly what we have been preaching. Folks who actually did buy in those 6 or 7 marks, many of whom were able to successfully negotiate 2-1 buy downs, 3-2-1 buy downs in order to make the rate more effective. That is a really popular strategy right now. So those folks will hopefully have the opportunity to refinance into what is predicted to be mid-5s by this year, maybe Q2, Q3. Stay tuned for that. Number 2, housing market activity will continue to strengthen. Now, as interest rates continue to lower themselves, we will see more activity from buyers and more activity from sellers, because as we know, interest rates have an effect on both the buyer market, the demand, and the seller market, the supply. Number 3, inventory will remain tight. Now, the metrics are a little bit misleading right now. I can also say from experience, just last weekend, we had multiple offer situations and many homes were going under contract on that first weekend. So it really does feel like inventory is going to remain constrained, especially as rates continue to fall. Number 4, appreciation to decelerate further. So this seems to be another thing that most thought leader real estate economists can agree upon, that we're going to see a slowdown of appreciation, where some markets will remain flat and others might see slight dips and others might see slight increases. So I want to pop over here to this National Association of Realtors article, 2023 Real Estate Forecast, Market to Regain Normalcy. Normalcy is a buzzword in real estate right now. A quote I want to pull out here: after a big boom over the past 2 years, there will essentially be no change nationally in home prices. In 2023, Yoon said, half of the country may experience small price gains, while the other half might see slight price declines. That's pretty interesting, and I absolutely agree. Some of those that have been inflated from the previous year's frenzy of buying, they could see flattening or a slight decrease, but certainly not a fallout, while others might see and should expect to see some small gains over the next year, but nothing like the double-digit appreciation we've become accustomed to recently. Number 5, persistent affordability challenges for middle-income earners and first-time buyers. Housing affordability hit record lows in 2022. In fact, it was 60% more expensive to purchase a home than it was the previous year. 60% for the same priced home. That's bonkers. Think more about timing your life and not timing the market. If you end up locking in an interest rate and interest rates fall below whatever rate you locked in, congratulations, you have the opportunity to refinance. That's a win. If rates go up from the rate that you locked in, congratulations, you have a rate that is below market rate and you're winning regardless of what inflation does. I'm a big believer in housing, a big believer in real estate. I'm Jason Sirois. I am available on all of the usual channels. Find me, hit me up, shoot me a DM, or call me if you would like to start your own real estate journey in the Denver area. Until next time, talk to you soon.